Hey everyone, welcome to this week's Closing Bell. Salt and Pepper back.
Salt and pepper, yeah.
Some of your favorite people we know.
Yeah.
I know you get excited to watch this news show, but we try to keep it fun and entertaining. Obviously, if you just want to read and not watch us, you can do so
You can do
below.
so.
But we're back here this week with some good numbers. Want to give you a little bit of an update on S&P 500 earnings season, right? So we're right in the middle, almost actually tail end of quarter two earnings season for 2023. We've had over 424 of the 500 S&P companies report earnings already.
Yeah.
So let's quickly go over the numbers. I want to get your thoughts on the numbers, kind of maybe where we're going from here. So of those 424 companies that have actually reported, we've had 64% beat revenue estimates and over 80% beat earnings per share estimates.
That's amazing, right? I mean, 80%. We were expecting a negative 7.2% earnings over S&P earnings over this quarter, and we're like what 5.6 negative. So beating that as well, and then as the rest of the companies report here, the next 75 plus whatever report the rest, the next couple of weeks, that could even drop to negative 3 to 4%. So much better than everybody expected.
A lot better.
Yeah, I mean, so that's good news. And again, I think it speaks to the fact that these corporations, we've been talking and thinking about recession for a long time, and they're just been really efficient in how they're doing business right now. So nice surprise.
What do you think about, obviously, earnings recession? Last quarter, we were down quite a bit in terms of earnings per share growth. It was contractionary. Have it again this quarter. Next quarter could be positive, so you could be seeing kind of the tail end of.
Yeah, there's lots of talk, and maybe the earnings recession's over. Next couple quarters will actually have increases in earnings. So we'll see. I mean, again, all that leads to what the Fed's going to do regarding the inflation numbers and what they do with raising rates, and if they continue to pause, that would be fantastic. The markets would like it, but right now the markets are they're just trying to we've had a little pullback even on this good news. It's interesting because there are people like, how come the market's not going up? This is good news. Well, we've had such a big run. Again, don't forget the market's always looking out 6-9 months. So it's already factoring in or pricing in what they believe is going to happen in the future. And usually, you buy the rumor, sell the facts. So when the good news actually comes out, you might have some selling. And we've been talking about the market needs to pull back a little bit and even go sideways for a while. And right now, it needs to take a breath. That's better for us long term. So again, stick to your portfolio, stay in. You never can determine what the markets are going to do, especially. And all the it's just more volatility. So it's part of being invested.
Good points. Good points. I like that. When you say buy the rumor, sell the facts. That's a really interesting way to put it.
Is that how you did? Yeah, exactly.
Yeah,
I mean,
that's
that's how a lot of traders work. Yeah. So they wait till a stock will run up based on all the hype and. Everybody's talking about, they're going to make this earnings, and then they hit the earnings, and all of a sudden you get a big sell-off. And we've seen that actually this week in a lot of the semiconductor areas where you've got microcomputer, some of these that have had just blowout earnings, and all of a sudden they sell off. It's like, what the heck? That's pretty normal, especially what you want to see is, if those individual companies can kind of hold their main support lines, like the 50-day or 10-week average, and the 200 days longer term. So we've had such an extension of those averages right now that we need, like I said, to come back and test and see how that goes. So you need to always wash out. So anyway, keep to your long-term plan. That's always stay invested. That's important.
Good points.
With good companies.
Speaking of the Fed, talked a little bit about what are they going to do moving forward. Obviously, September meeting's coming up here. Before we know it, the year's flown by already. Hopefully, like we've been talking about, hopefully they hold where they're at. We don't need more rate hikes that haven't even been baked into the cake yet for the past 2 quarters at least. So we can kind of see, again, some areas of the economy contracting more than others. We talked about rolling recession last week, maybe rather than 2 quarters negative growth and then having positive GDP growth and then having 2 other quarters of negative growth. We've had different sectors in contractionary periods: manufacturing, semiconductors, real estate, whatever, regional banks, whatever it may be. We've had those contractions. So I want to get your opinion on this. So with the Fed coming up, again, the September meeting, we had the most recent CPI numbers that came out today. So headline CPI came in at 3.2%. Core CPI came down 10 basis points from last month from 4.8 to 4.7. So stickier than we thought.
Yeah.
Like, what are we thinking?
Not really stickier. We've been, you and I have been talking about the fact that we're going to be higher for longer. That's what we've been planning on. I think the 2% is unrealistic long term. I mean, if you go back 80 years, it's averaged 4%,
Right.
In that period of time. And that's a lot of different economic cycles. So I think it's going to be, higher for longer.
Yeah.
And I guess the hope is that the Fed will realize, it takes a while for interest rate increases to work its way through an economy. And we're seeing, even this week, more bad news on regional banks, things like that. So everybody's trying to grapple still with the higher interest rate. So I think that's really going to slow things down. And we've had some numbers come out. Credit card, for the consumer, we hit $1 trillion in credit card debt this year. But that couple, that's the headline number, the scare number. But there's also some decent good things going on behind the scenes, higher savings rates, things like that. Again, the consumer has been thinking about us as we've been talking about recessions forever, and I think everybody's sort of prepared to get more higher savings rates. Yes, they are putting more money on credit cards. But there's a lot of different things involved in that. But I think that the fact is, overall the consumer's pretty decent shape still.
That's good to know. So we'll keep you updated on kind of most recent happenings. But for this week's closing bell, make sure you subscribe, you like, you comment on social media. We really appreciate to hear your feedback, and it's an honor to serve you guys. We'll see you next week.
Take care. God bless you.